to number 1 again.
My name is Jinting Wang from San Diego, California. What's that? Oh, yes. First, I would thank both of you. My question is also about growth and value. If you look at the business in this country, most of them, if not all of them, are cyclical to various degree. Certain businesses are, of course, more cyclical than other businesses. So when you buy a business or make an investment in stock, do you have a cutoff? Like if a business loses money in a downturn, we are not going to buy. If its earning begin to decline in a downturn, we are not going to buy. But if the earning growth slows down, then we can look at the business and make an investment. So do you have a cutoff in terms of this cyclical factor? And also, when you buy a business, in terms of the current PE ratio, also do you have a cutoff? Let's say if its PE ratio is more than 15, 16, we are not going to buy the business no matter how much the earning may grow in the future. And so basically it's about the growth and the value.
Yeah, we have, to answer your question directly, we have no cutoff whatsoever. We don't think in terms of absolutes that way because, again, we are trying to think of how many birds are in the bush. And sometimes the number that are currently being shown could be negative. One of the best buys we ever made was in 1976 when we bought a significant percentage, what became through repurchases 50% of Geico, at a time when the company was losing a lot of money and was destined to lose a lot of money in the immediate future. And you know, the fact they were losing money was not lost on us, but we thought we saw a future there that was significantly different than the current situation. So it would not bother us in the least to buy into a business that currently was losing money for some reason that we understood and where we thought that the future was going to be significantly different. Similarly, if a business is making some money, there's no PE ratio that we have in mind as being a cutoff point at all. There are businesses, I mean, you could have some business making a sliver of money on which you would pay a very, very high PE ratio. But it's basically, we look at all of these as businesses. We are, for example, at Executive Jet, NetJets, we're losing money in Europe. Well, we expect to lose money in Europe getting established. So does that mean it's a bad thing to buy 100% of if you own the whole company, or 3% of if Executive Jet was a public company and you were buying into it? No, I mean, there are all kinds of decisions that involve the future looking different in some important way than the present. Most of our decisions relate to things where we expect the future not to change much. But you get this, well, American Express was a good example. And when we bought it in 1964, a fellow named Tino DeAngelis had caused them incredible trouble. You know, it was one of those decisions that looked for time as if it could break the company. So we knew if you had been charging for what Tino had stolen from the company against the income account that year or the legal costs that were going to be attached to it, you were looking at a significant loss. But the question was, what was American Express going to look like 10 or 20 years later? And we felt very good about that. So there are no arbitrary cutoff points, but there is that focus on how much cash will this business deliver, you know, between now and kingdom come. Now, as a practical matter, if you estimate it for 20 years or so, the terminal values get less important. So, but you do want to have in your mind a stream of cash that will be thrown off over, say, a 20-year period that makes sense discounted at a proper interest rate compared to what you're paying today. And that's what investment's all about. Charlie?
Yeah, the answer is almost the exact reverse of what you were pointing toward. A business with something glorious underneath, disguised by terrible numbers that cause cutoff points in other people's minds, is ideal for us if we can figure it out.
Yeah, we've had a couple of those in our history that have made us a lot of money. I mean, we don't want to wish anybody ill, but
Oh, I wouldn't go that far.
okay, well, Charlie. I think he's speaking for both of us. Okay, we'll move on to number 2.
Mr. Buffett, I would like to start my question by giving you and Charlie 10 lashes with a wet noodle, not because of 1999 and what happened to your net worth or our net worth, but because you have spoiled your shareholders into expecting 25% growth every year since 1965. And then comes the bad 1990, and it hits all of us. But by my calculations, you personally, Mr. Buffett, have lost over $10 billion, not million, billion dollars during 1999. So I don't think we should get too mad at you, because probably all of us have, at this point in our life, increased our net worth and made a lot of money. Now, so you don't get a wet noodle today. And the shareholders have, I'm sure, lost thousands, and some have lost millions of dollars during the year 1999. Now, after reading your biography in November of 1998, unfortunately, I didn't know about you earlier, I started investing on November the 24th of 98, and of course I'm a poor little investor, so I bought your B stock at 23.08. Then, because the market dropped, I bought some more on the 4th of December at 22.29, and then I bought on January the 24th of 2000 at 16.89. So I do believe in dollar cost averaging, and I've been doing that for probably 30 years of my life. My January investment, I'm happy to say, is up 15%. So the worst may be over. Now, I read your annual report, and I want to compliment you that that is the easiest and most entertaining annual report, I think, created in the whole world. And I hope you continue that kind of a
Thank you.
report. Oh, I'm sorry, I was just told that I should have said who I am. My name is Gaylord Hanson, and I'm from Santa Barbara, California, where Mr. Munger puts his big multi-million-dollar boat in the water.
I'm not going to make any comment on that.
Please don't. Now, with technology, computers, electronics, and software transforming our entire world, not just here, the world, I must admit that I personally invested in 4 technology, computer, software, and aggressive growth mutual funds, and made up all of my 1999 losses on Berkshire Hathaway. Are we asking too much as shareholders of Berkshire Hathaway for you men to put your brains to work and possibly speculate a little bit, maybe 10% of our money into the only play in town, which seems to be technology, electronic, and I've read your report and I understand a lot of your reasoning that it's difficult, and it is difficult, to project earnings of a lot of people. They're going to go bankrupt or they're going to go out of business, but isn't there enough left in your brain power to maybe pick a few and see what's going on? Because I made over 100% profit in 1999 on my aggressive position in the technology field. So that's
Okay, well, the answer we will never buy anything we don't think we understand. And our definition of understanding is thinking that we have a reasonable probability of being able to assess where the business will be in 10 years. But, we'd be delighted. We have a man here who's done very well, and if he has any business cards, you can always invest with him, and we'd welcome. We'll give you a booth in our exhibitor section, and anybody that wants to do that is perfectly obviously free to do it with you or through anybody else that they select. Now, you have a whole bunch of people out there that say they can do this. And maybe they can and maybe they can't, and maybe you can spot which ones can and can't. The only way we know how to make money is to try and evaluate businesses. And if we can't evaluate a carbon steel company, we don't buy it. It doesn't mean it isn't a good buy. It doesn't mean it isn't selling for a fraction of its worth. It just means that we don't know how to evaluate it. If we can't evaluate the sensibilities of putting in a chemical plant or something in Brazil, we don't do it. If somebody else knows how to do it, more power to them. There are all kinds of people that know how to make money in ways that we don't. But, it's a free world and everybody can invest in those sort of things. But they would be making a mistake, a big mistake, to do it through us. I mean, why pick a couple of guys like Charlie and me to do something like that with when you can pick all kinds of other people that say they know how to do it? I would say this, incidentally. You mentioned a point earlier, which is how the popular press tends to think of things, but we don't consider ourselves, Charlie and I don't, richer or poor based on what the stock does. We do feel richer or poor based on what the business does. So we look at the business as to how much we're worth, and we do not look at the stock price, because the stock price doesn't mean a thing to us. I mean, it doesn't for a variety of reasons, but beyond that, imagine trying to sell hundreds of thousands of shares at the stock price. We can always sell the business. We're not going to do it, but we can always sell it for what the business is worth. We can't sell our stock for necessarily what the stock price is. So we look at the business entirely as in terms of evaluating our net worth. We figure our net worth went up very, very slightly in 1999. And we would figure that no matter what the stock was selling for. It just doesn't make any difference, because we do look at the businesses. We really look at it as if there wasn't any quote on the stock, because we don't know what the stock is going to do. If the business gets worth more at a reasonable rate, the stock will follow over time. But it won't necessarily follow week by week or month by month or year by year. We had a lousy year in 1999, but the stock price did not calibrate with that in any perfect or close to perfect manner. And we've had good years other times when the stock price is way overpriced or over-describe what happened during the year. So we really measure it all the time by the business. We think of it as a private business, basically, for which there's a quotation, and if it's handy to use that quotation, either in buying more stock or something of the sort, we may do it. But it does not govern our ideas of value. Charlie?
Yeah, generally I would say that if you have a lot of lovely wealth in a form that makes you comfortable, and somebody down the street has found a way to make money a lot faster in a way you don't understand, you should not be made miserable by that process. There are worse things in life than being left behind in possession of a lot of lovely money. I mean,
would you want to name a couple? No, Charlie, I mean, when farmland farmland probably tripled here in the late 70s without any real change in yields per acre or the price of the commodity. Are we going to sit around and stew because we didn't buy farmland at the start? Are we going to stew because all kinds of uranium stocks in the 50s, or you can go back all kinds of things that the conglomerates in the late 60s, the leasing companies. I mean, you can just go down the line, and it just doesn't make any. We're not in that game. We would know how to create a chain letter, believe me. I mean, we've seen it done so many times. We know the game, but it just isn't our game. Charlie? Okay. Number 3.
Good morning, Mr. Buffett, Mr. Munger. My name is Stacy Braverman. I'm 15 years old, and I'm from South Setauket, New York. It was really nice meeting you, Mr. Buffett, yesterday.
Thank you.
I especially appreciated your internet stock tips.
Yeah, keep it to yourself now, Stacy. That's our deal.
I bought the B shares 2 years ago when I decided that I needed to save some money for college. When the share price dipped below 1,500, I decided to investigate correspondence courses.
Maybe you can get a scholarship.
So I'm glad to see that things are back on track now. My question is, a lot of the companies that you invest in, like Coca-Cola and Gillette, seem to do better when the dollar is weak and interest rates are falling. That seems to be the opposite of what's happening now. So how is Berkshire positioning itself to take advantage of the current economic position with that assessment in mind?
Yeah, well, that's a good question. But if we thought we knew what the dollar was going to do or interest rates were going to do, we won't do it, but we would just engage in transactions involving those commodities in effect or futures directly. In other words, it would not be, if we thought that the dollar was going to weaken dramatically, and we won't get those kind of thoughts, but if we did, we would buy other currencies, and it might benefit Coke in dollar terms if that happened, but it would be so much more efficient directly to pursue a currency play or an interest rate play than an indirect way through companies that have big international exposure. We would probably do it directly. We don't really think much about that because just take currency. If you look at what the yen has traded at, over the last, since World War II, from, 360 down to, 70 some, Charlie, went at the low, and back up to 140 some, and now, 105 or wherever it may be. I mean, those moves are huge, but in the end, we're really more interested in whether more people in Japan are going to drink Coca-Cola, and over time, we're better at predicting that than we are at predicting what the yen will do. And if Coca-Cola satisfies people's needs, liquid needs, for more and more people, we will probably get a reasonable percentage of their purchasing power of those people around the world for their right to drink Coca-Cola or for shaving or whatever it may be. So if the world's standard of living improves bit by bit over time in an irregular fashion, and we supply something the world wants, we will get our share in dollars eventually. And what quarter to quarter or year to year, how that moves around because of currency moves really doesn't make any difference to us. It makes a difference to reported earnings in that quarter. But in terms of where Coca-Cola is going to be 10 or 20 years from now, it would be a big mistake, I think, to focus on currency moves as opposed to focusing on the product itself. And Japan offers a good example of that because you had this, you really had a move from 360 or whatever it was to the high 70s or thereabouts. That is an incredible move in currency, and it can overshadow in the short run even what's happening in the business. But long range, what's really made Coca-Cola strong in Japan is the fact that the Japanese people have accepted their products in a big way, and Coca-Cola has built this tremendous, for example, vending machine presence. And the Japanese market is very different than all the rest of the markets in the world virtually, in that such a high percentage flows through vending machines. And my memory is that we may have something like 900 and some thousand out of something over 2 million vending machines in the country. So we've got this tremendously dominant position. It's a little like billboards might be in this country. Plus we have this terrific product, Georgia Coffee, which is huge over there. And that's the sort of thing we focus on because that's something we understand. We don't understand what currencies are going to do week to week or month to month or year to year. And we always try to focus on what's knowable and what's important. Now, currency might be important, but we don't think it's knowable. Other things are unimportant, but knowable. But what really counts is what's knowable and important. And what's knowable and important about Coca-Cola is the fact that more and more people are going to consume soft drinks around the world and have been doing so year after year after year, and that Coca-Cola is going to gain share, and that the product is extraordinarily inexpensive relative to the pleasure it brings to people. Coca-Cola in the 30s, when I was a kid, I bought 6 for a quarter and sold them for a nickel each. That was a 6.5-ounce bottle for a nickel at Coke. And you can buy a 12-ounce can now at pick a supermarket sale for not much more than twice per ounce what it was selling for in the 30s. You won't find many products where that kind of a value proposition has developed over the years. So that's the kind of thing we focus on. And interest rates and foreign exchange rates, important as they may be in the short term, really are not going to determine whether we get rich over time. The best time to buy stocks actually was in recent years, has been when interest rates were sky high, and it looked like a very safe thing to do to put your money into Treasury bills at actually the prime rate got up to 21.5%, but you could put out money at huge rates in the early 80s, and as attractive as that appeared, it was exactly the wrong thing to be doing. It was better to be buying equities at that time, because when interest rates changed, their values changed even much more. Charlie?
Yeah, we have a willful agnosticism on all kinds of things, and that makes us concentrate on certain other things. This is a very good way to think, if you're as lazy as we are.
We'll go to 4, please.
Jerry Zucker, Los Angeles, California. Good morning, boss. Calling your attention to the annual report and major investments. I appreciate your comments on 2 companies. Number 1, M&T Bank, a new name to that list, but not exactly a household name, at least on the West Coast. And company number 2, definitely a household name, but missing from the list this year, the Walt Disney Corporation.
Well, we don't comment much on our holdings, particularly as to purchases or sales, but we do have the CEO, longtime CEO of M&T here today, Bob Wilmers. Bob, would you stand up? He should be up here somewhere. There he is. Bob is a terrific businessman, a terrific banker, and a terrific citizen. I've known him a long time. Good friend of Stan Lipsey, our publisher in Buffalo. Bob runs the kind of a bank that allows Charlie and me to sleep very comfortably. Someone once said there are more banks than bankers, which is something we're thinking about a little bit. But believe me, Bob is a banker and has done a lot for Buffalo. And he has a very big ownership position, which he achieved, at least in very large part, through purchase with his own money as opposed to having options. He's got one of the largest ownership positions, probably among the 100 largest banks in the United States. And it's just a very attractive business for us to be in, and we're very comfortable with it. And 10 years from now, Bob will be here, and I hope I'm here, and we'll probably own M&T. The Disney company, our ownership in that fell below the threshold level which we used, although we had ownership, and we think Disney is a terrific business. Michael Eisner's done a great job there. We have, as we put in the annual report, we have mildly reduced equities as prices generally began to get more and more full. We do not think the general ownership of equities is going to be very exciting over the next 10 or 15 years. So we would like to buy businesses. We bought a few last year. We had this one we announced last week in the insurance field. We've got another small acquisition where we've got an agreement with somebody who's very small. But we would love it if those were 10 times that size or 20 times that size, because you will see more of that relative to marketable securities as we go along. Charlie?
Yeah, regarding equities generally, I think that Fortune article, which was sent out to the Berkshire shareholders this year, should be absolutely must reading for everybody. In fact, it would be a good thing to read 2 or 3 times. The ideas there sound so simple that people have the theory that they must understand it, but I think the world is more complicated than that. I think we are in for reduced expectations eventually with respect to the kind of returns people have had from investing in stocks.
Do you want to offer any thoughts as to what what the corollary might be?
Well, I think if you have very unreasonable expectations of life, it makes life much more miserable. Much better to get your expectations within reason. It's much easier to reduce expectations to some reasonable level than it is to get superhuman achievements.
That's why my kids were almost delirious when they heard that announcement. I was going to give them $300 each, and they how to be? Do you want to be a zillionaire or whatever it was? Incidentally, that was terrific of Regis Philbin to do something like that. I mean, all of those appearances are non-paid, I can assure you. Those people are good, very, very good sports, and I thank them. Okay, we'll go to Zone 5.
My name is Monty Leffoltz from Omaha, Nebraska. I have a two-part question. What is Berkshire's philosophy on paying dividends, and under what circumstances would Berkshire pay a dividend in the future?
Well, that's a good question. We paid a dividend in, 1969, Charlie, and at 10 cents a share. I can't remember it, but it's in the records. We would be very likely to pay either very large dividends or none at all, because our test is whether we think we can use money at a rate in a way that it creates more than $1 of market value for every dollar we retain. Obviously, if we can keep $1 and it becomes, on a present value basis, worth more than $1, it's foolish to pay it out. Forget all about taxes. Assume it's a tax-free society. We would have exactly the same dividend policy up to this point, whether there was any tax on dividends, capital gains, or anything else, or whether we were entirely tax-free, because we have retained money, because to date we have felt that if we keep $1 and use it in buying other businesses or whatever it may be, that it becomes worth more than $1 on a present value basis. I mean, not that it's going to be worth $1.10 4 years from now, but it's worth more than $1 when we look at what it'll be 4 years from now. That's subjective, but any given decision like that is subjective. Over time, you get an objective test as whether that's met by whether we do indeed create more value than each dollar of retained earnings. We create an extra dollar plus of value. If that changed, and it could change, then we would give the money to the shareholders, and it might be done through repurchases or it might be done through dividends. But there's no reason to keep $1 in the business that's worth 90 cents if you keep it in the business. And there are companies that do that, but they're not necessarily intentionally doing it. They may have higher aspirations as they go along, but they're not realized. We, I think, would be fairly objective about trying to figure out whether we are indeed creating value or destroying value by retaining earnings. We would never have a conventional dividend policy. I mean, the idea of paying out 20% of your earnings or 10% or 30% of earnings in dividends strikes us as nuts. I mean, you may get yourself in a position where you have to do it because you build these expectations in people's minds, but there is no logic to it whatsoever. The logic is basic. If you create more than $1 of value for $1 retained, why in the world would you pay it out? Because the people who want to get that $1 as a dividend can instead get $1.10 by selling the stock for, or whatever it may be, $1.20 for the value that was maintained and or retained. So that it's a very simple dividend philosophy, and one I think that's in one of the past annual reports. We explain the logic of it, and I see nothing that would change in terms of the principles of it. Evaluating whether that's the case. I mean, obviously we aren't going to make a decision every week based on whether we can employ money that week at a higher rate of return or every month. But in terms of a reasonable expectancy over a couple-year period, whether we think we can use retained earnings advantageously, that's our yardstick. Charlie?
Yeah, what's interesting about what Warren is saying about logical dividend policy is that if you went to all the leading business schools of the United States, all the leading economics departments, all the professors of corporate finance, this wouldn't be the way they teach the subject. In other words, we're basically saying we're right and all the rest of academia is wrong.
We love it when we do that. Okay, we'll go to 6.
I'm Mark Cheer from Hong Kong. And Mr. Buffett, I'd like to ask you a couple of questions. The first one is, how many insurance companies does Berkshire Hathaway own? I can't figure out the total.
Let me answer that, and then you go on to your second one. We have a great number of companies because in many cases a given strategy or a given operation operates through multiple companies. The company we announced the purchase of the other day is really one business, but it has 3 companies. I wouldn't be surprised. I've never looked at the number, but it wouldn't surprise me if we have 20 insurance companies or something, maybe 25 or 30, who knows. We have about 9 or 10 basic insurance operations for which a given management has responsibility. But there's a lot of state laws applicable to insurance companies and different regulations, and it's often advantageous to have a number of companies operating under one management to achieve one operational goal. The big operations are General Re and Geico and the National Indemnity Reinsurance operation run by Ajit. And then we have a group of about 5 different operations that are all very, very decent businesses, but are not as big as the 3 I mentioned. Go ahead.
Thank you. Okay, my main question is this. Much has been written by you and a lot more by other people about your criteria or the criteria you use when you make a purchase of a company, either in full or in part. But almost nothing has been written by you, at any rate, as far as I can tell, on your criteria for selling a company that you have previously purchased. And I wonder if you could outline the criteria you might apply today to a sale of a company, and whether you would go well, the simplest way to put it is this: would you agree with Philip Fisher, who said there were 2 reasons to sell a company or a stock? One was when you discovered you'd made a mistake in your analysis and the company was not what you thought it was. And the second was when something within the company had changed, the management had changed or so on, so it no longer met your original criteria. So are those the principles that you apply, or would you say there are different ones or others? Thank you.
I'm glad you brought up Phil Fisher because he is a terrific mind and an investor. He's probably in his 90s now, but a couple of books he wrote in the early 60s roughly are classics, and I advise everybody here who's really interested in investments to read those 2 books from the earlier 60s. And he's a nice man. I went out 40 years ago, I dropped into his office in San Francisco, a tiny office, and he was kind enough to spend some time with me, and I'm a huge admirer of his. The criteria that we use for selling a business that we own control of are articulated in the annual report under the ground rules. So in terms of businesses that we own, we have set forth, and I direct you there, we've written those same ground rules every year since 1983, and actually we had those in our head for decades before that. And we have this quirk, which you should understand, and we want our shareholders to understand it, that even though we got offered a price that was far above its economic value as we might calculate it going in, but if we got offered a price for that for a business that we have now, we have no interest in selling it. We don't break off the relationships that we develop simply because we get offered a fancy price for something, and we've had a chance to do that sometimes. That may help us actually in acquiring businesses, because both of the companies that I've committed to buy in the last few weeks, both of them are very concerned about whether they have found a permanent home or not. And people who build their businesses lovingly over 30 or 40 or 50 years frequently care about. A lot of people don't care about that, and that's one of the things we evaluate when buying a business. We look at the owner and we say, do you love the, in effect, we ask ourselves, does he love the business or does he love the money? Nothing wrong with liking the money. In fact, we'd be a little disappointed if most of them didn't like the money. But in terms of whether the primacy is loving the money or loving the business, that's very important to us. And when we find somebody that loves their business and likes the money but loves their business, we are a very, very desirable home for them, because we're just about the only people that they can deal with of size where we can commit that they are going to be part of this operation really forever, and be able to deliver on that promise. I tell sellers that the only person that can double cross them is me. I can double cross them, but there's never going to be a takeover of Berkshire. There's never going to be a management consultant come in and say, I think you better do this. There's never going to be a response to Wall Street saying, why aren't you a pure play on this or that, and therefore you ought to spin this off. None of that's going to happen. And we can tell them with 100% assuredness that for a very long time, that if they make a decision to come with Berkshire, that decision will be the final decision as to where their company resides. So unless of those couple conditions, which are extremely unusual, that are described in the ground rules, prevail, we will not be selling operating businesses, even though someone might offer us far more than logically they're worth. The question about stocks, we're not quite with Phil Fisher on that, but we're very close. We love buying stocks where we think the businesses are so solid, have such economic advantage, that we can essentially ride with them forever. But you've heard me talk about newspapers earlier today. We would have thought newspapers 20, 25 years ago, I think Charlie and I probably thought a daily newspaper, in a single newspaper town, which practically all are, is probably about the solidest investment you could find. We might have thought a network TV affiliated station was about as solid as you could find. And they were very solid. But events have, over the last 20 or 25 years, have certainly changed that to some degree, and maybe to a very, very big degree. So we will occasionally reevaluate the economic characteristics that we see 10 years out from the ones that we saw 10 years ago, and maybe come to a somewhat different conclusion. The first 20 years of investing for me, or maybe more, my decision to sell almost always was based on the fact that I found something else I was dying to buy. I mean, I sold stocks at 3 times earnings to buy stocks at 2 times earnings 45 years ago, because I was always running out of money. Now I run out of ideas. I've got a lot of money but no ideas. And I'm not sure which is better. What do you think, Charlie?
I think you were way better off when you had 50 years ahead of you and less money.
I still think I have 50 years ahead of me, Charlie. You want to elaborate any more on selling?
Yeah, we almost never sell an operating business, and when it does happen, it's usually because we've got some trouble we can't fix.
Okay, number 7.
Hello, I'm Martin Wiegand from Chevy Chase, Maryland.
Oh.
And though you've given yourself a D in capital allocation, on behalf of the shareholders, we would like to give you an A+ in honesty in accounting, temperament for a long-term investing view, and hosting an annual meeting.
Thanks. I went to school with Martin's father. Good to see you here.
Thanks. Now my question. Do General Re's competitors pay their employees with a rational incentive plan aimed at growing float and reducing its cost, or do they use something similar to General Re's old plan? And is this a new, sustainable, competitive advantage for General Re?
Well, I think a rational compensation plan, and I think we have rational compensation plans, we certainly aim at that, and we don't care what convention is. Over time, we'll select for people who are rational themselves, who have confidence in their abilities to deliver under a rational plan, and who really appreciate operating in that kind of an environment. Now, who wouldn't want a lottery ticket? I mean, if anybody here wants to buy a few lottery tickets, at the lunch break and come up and present them to me, I'll be glad to take them. I don't think it will have anything to do with my performance at Berkshire Hathaway or anything in the future. And so we try to make plans that are very rational. And incidentally, we've never had any real problems at all in working with managements to do just that. The two operations that I've just recently agreed to buy, we will have rational compensation plans at those places, and they'll be somewhat different, perhaps, than the ones they've had in the past, although not much different as I think about it. I think it's been a huge advantage at GEICO to have a plan that is far more rational than the one that preceded it. And I think that advantage will do nothing but grow stronger over time, because in effect, compensation is our way of speaking to employees generally. And when places large as GEICO, you can't speak to them all directly. But it speaks to them all the time. It says what we think the rational measurement of productivity and performance in the business is. And over time, that gets absorbed by thousands and thousands of people. And it's the best way to get them to buy into their goals. Whereas if you use as your test what the stock market is going to do, people, I think, inherently know they got a lottery ticket. I mean, you've seen that in a lot of tech stocks in the last 3 or 4 months. You will find all kinds of options being repriced or issued in great abundance at lower prices without repricing them because they don't want to have the accounting consequences. And those people know they're getting lottery tickets, basically, and that the market's attitude towards tech stocks is what's going to determine results far more than their own individual results. So it's silly to think of somebody working very hard at some very small job at Berkshire with our aggregate market value of $90 billion, thinking that their efforts are going to move the stock. But their efforts may very well move the number of policyholders we gain or the satisfaction of policyholders, and if we can find ways to pay them based on that, we are far more in sync with what they can do, and they know it makes more sense. So I hope our competitors do all kinds of crazy things on comp and everything else. I mean, the more dumb things they do, the better life is for us. And I think that, we've had incredible success at keeping managers. I don't think there's probably any company in the United States of size that has had better luck on that than Berkshire. And partly it's because we appreciate in terms of the comp plan, and partly because we just appreciate generally managers that do a terrific job for us, and we've got the best group in the world. Charlie?
Yeah, here again we're very much out of step with the conventions of the world. When I read annual reports, and I read a lot of them, I'm very frequently irritated by the presence of things that are totally absent from the Berkshire Hathaway annual report. I think promising people free medical care forever between age 60 and the grave, and maybe for a younger spouse after the grave of the first one, regardless of what's invented and regardless of what it costs. I don't see anybody who cared about the shareholders would be making promises like that. There's a lot of insanity in conventional corporate conduct on the pay front, and but if convention determined what was sane and what was insane, we're the oddballs. I mean, we're the unusual example.
I think it's very subconscious on it. I think sometimes the desires of the top person to get an outrageous amount gets pyramided through the organization, because if they're going to have some scheme that rewards them based on a lottery ticket, they feel they have to give lottery tickets to everybody else, although on a much reduced scale. And they really do. I mean, it's just it becomes accepted, and of course then you hire consultants and come around and say, well, you're getting more lottery tickets at someplace else, and we've got some added new schemes. It becomes very, very reinforcing. But what has happened at the top level is really unbelievable. I mean, if an executive said to his company, I want an option on just for working here, I want an option on $300 million worth of S&P futures for the next 10 years, people would regard that as outrageous. They'd say, what have you got to do with that? But in effect, if they get one on their own stock and it goes up based on the fact the S&P appreciates over 10 years, they think that that's perfectly acceptable to have that kind of a ride. So I would say that, there's been a lot of talk about the huge gap between, that exists in pay, but it seems to me that the primary gap that is eating at American CEOs is the gap between the rich and the super rich. That seems to be motivating the adoption of many plans. It's gotten out of hand, but it isn't going to change. The CEO has his hand on the switch as a practical matter. I know people, and I've been on them myself, but on comp committees, and as a practical matter, you don't stand a chance.
Yeah, a lot of the corporate compensation plans of the modern era work just about the way things would work for a farmer if you put a rat colony in the granary.
Put him down as undecided. Good to see you, Martin. Okay, let's go to 8.
Good morning, Mr. Buffett and Mr. Munger. My name is Ram Tarakard from Sugar Land, Texas. I've been a Berkshire shareholder since 1987 and always battling with the idea of what really is the intrinsic value for the company. We have seen that over time, a change in book value is a vague indicator of the change in intrinsic value of Berkshire. Although in absolute terms, you have said again and again that intrinsic value. In calculating the book value of Berkshire, our partly owned businesses like Coke and Gillette are valued at their market value. This component of book value fluctuates, often irrationally, depending on the mood of the market. Do you think that using a look-through book value, just like you use look-through earnings, is a superior measure for tracking changes in intrinsic value? In fact, I had written a letter to you last August, and I was very pleased to get a response from you personally saying that this approach makes sense. My question is, does this approach really give you a better measure for tracking intrinsic value? And if so, would you consider publishing it in the annual report? Thank you.
Yeah, thanks for the question. I would say that I'm not sure how you phrased it when you wrote me and how I phrased it going back, but look through book value would not mean much, actually. The very best businesses, the really wonderful businesses, require no book value. We want to buy businesses really that will deliver more and more cash and not need to retain cash, which is what builds up book value over time. Admittedly, the prices of marketable securities at any given time are not a great indication of their intrinsic value. They are far better, though, than the book value of those companies in indicating intrinsic value. Berkshire's intrinsic value in a very general way, and trends in it are better reflected in book value than is the case at a very high percentage of companies. It's still it's not a great proxy. It's the best. It's a proxy that is useful in terms of direction, in terms of degree, in a general way over time, but it's not a substitute for intrinsic value. In our case, when we started with Berkshire, intrinsic value was below book value. Our company was not worth book value in early 1965. You could not have sold the assets for that price that they were carried on the books. No one could make a calculation in terms of future cash flows that would indicate that those assets were worth their carrying value. Now it is true that our businesses are worth a great deal more than book value, and that's occurred gradually over time. So obviously there are a number of years when our intrinsic value grew greater than our book value to get where we are today. Book value is not a bad starting point in the case of Berkshire. It's far from the finishing point. It's no starting point at all of any kind in whether it's the Washington Post or Coca-Cola or Gillette. It's a factor we ignore. We do look at what a company is able to earn on invested assets and what it can earn on incremental invested assets, but the book value we do not give a thought to. Charlie?
Well, I think that's obviously correct.
he'll come back next year. Number one.
Hello, gentlemen. My name's Dan Sheehan. I'm from Toronto, Canada. First of all, I'd like to thank you for this weekend. It's become more and more important to me as it's become more and more difficult to find rational discussion about the stock market, and this weekend really is a breath of fresh air for most of us, I think. One of the places I refer to a lot is Benjamin Graham, and what worries me now is what he referred to as a period in 1929 and the early 30s is a lab experiment where normal intrinsic values and margins of safety broke down, or seemed to anyway. And I wonder how much you think that might happen now in the next few years, and how much you worry about that with the investments you're making.
Well, we generally believe you can just see anything in markets. I mean, just extraordinary what happens in markets over time. It gets sorted out over, eventually. But I mean, we have seen companies sell for tens of billions of dollars that are worthless, and at times we have seen things sell for 20%. A number of things, not hard to find, perfectly decent people running them, sell for literally 20% or 25% of what they were worth. So we have seen and will continue to see everything. It's just the nature of markets. They produce wild things over time. And one of those wild things, and not to get carried away when other wild things happen, because the wild things create their own truth for a while, and you have to, that's the reason they're happening, and people are getting pleasant experiences and all that. You'll see everything if you're around markets for a reasonable period of time. We don't see any great cases of dramatic undervaluation by this market. So it isn't like we're seeing, because there's perhaps this speculative mania in a particular area of the market. We do not see that creating incredible undervaluation other places. What's happening there may lead to undervaluation, a few years from now, or it may not. I don't know that, but it isn't like you can find things that are worth double or thereabouts what you're paying, because frankly there's so much money sloshing around that if you found such a thing, it would be very likely corrected by some buyout types. I mean, we would love to find businesses that are selling for half of what they're intrinsically worth. We don't find that. We do find a lot of cases where we think the valuations on the high side are unbelievable. We have been in periods in the past where we felt almost everything was being given away too. So you'll get those extremes. Most of the time the market's in a position where there's a little of both, but every now and then it gets into a position where there's a lot of one or the other. And we would love it if we could find a lot of reasonable sized companies that were selling at what we thought were half of the intrinsic value. We're not finding them. Charlie?
Well, I do think that the present time is a very unusual period. It's hard to think of a time when residential real estate and common stocks and so on rose so rapidly in price, and there was so much easy money floating around. I mean, this is a very unusual period.
What's fascinating, and I'm sure you thought of it, is that you can now have a business, saw a few of them, earlier this year, we'll say, that might have been selling for $10 billion, where the business itself could not have borrowed probably $100 million in debt with an equity valuation of $10 billion. But the business itself would not, as a private business, would not have been able to borrow $100 million. But the owners of that business, because it's public, can borrow many billions of dollars on their little pieces of paper because they have this market valuation. If it's a private business, the company itself couldn't borrow 1/20th or so what the individuals could borrow. That's happened to a degree before, but this has probably been as extreme as anything that's happened, probably including the 20s. That doesn't mean there's a parallel to it, but it's been pretty extreme. Charlie?
I think it probably is the most extreme that has happened in modern capitalism. In my lifetime, I would say the 30s were it created the worst recession in the English-speaking world in 600 years. And it was very extreme. You could buy all you could eat in Omaha through the 30s for a quarter from Henderson's cafeteria. And now we're seeing the other face of what capitalism can do. And this is almost as extreme as the 30s were, but in a different direction. It's zero unemployment, rampant speculation, et cetera, et cetera. It's an amazing period.
That does not make it easy to predict, however, the outcome.
No.
It says to us, though, certain things we want to stay away from. I mean, basically, it's precautionary to us. It does not spell opportunity, although there's no question that in the last year, the ability to monetize shareholder ignorance has never been exceeded, I think. Wouldn't you say so, Charlie? Okay, number 2.
Good morning, gentlemen. David Wynn, New Jersey. Thanks again for Berkshire Fest 2000 and having it on Saturday for those of us who tap dance to work on Monday. Over the previous 30 years or so, Berkshire has been a tactical participant in the insurance business. With the acquisition of Gen Re and the broadening of Geico's scope, the company's been transformed into a mainstream activity. How will this transformation result in growth and low-cost float over time, i.e., how do you avoid becoming average? And to follow on with the very perceptive 10-year-old from California's question, will Berkshire's newspaper interests be able to make the successful transformation to the new electronic world, especially the unique content of the Washington Post? Thank you.
Those are both good questions. I think to answer your second one, I think the Buffalo News will do just as well as if you take the top 50 papers in the country in making a transition. How well the top 50 will do is really an open question. But there is, the industry factors will, in my view, just overwhelm any specific strategy, because any strategy is it's so easy to copy in the internet. That's one of the problems of the internet. It's one of the problems of capitalism. I mean, if you open a restaurant that's successful, somebody's going to come in and figure out what your menu is and how, the whole thing, and then they're going to try and do it in a little bit better location or at a little lower price or whatever. That's what capitalism's all about, and it's terrific for consumers. The internet accentuates that process. I mean, it gives everybody in the world real estate. There are no prime locations to speak of. I mean, I can give you the argument for how you develop one and all of that, but it really changes the world in a big way. If you were at 16th and Farnham in Omaha in the 20s with Woolworth, that's the place where the streetcar tracks crossed. And a whole bunch of them were going north-south there and east-west, and there wasn't any better real estate in town. I'm not sure if that's worth as much now in nominal dollars as it was in the 1920s, and that looked permanent instantly. Who was going to rip up the streetcar tracks in 1910 or whenever it was? So now you rip up the tracks every day, and so the fluidity is incredible in terms of moving economic resources around compared to what it was. The newspaper industry is going to try and figure out how to be a very important information source in a new medium. And it may solve that problem to a degree and still have lousy economics. That's unfortunately, the newspaper industry is always, historically, the way the industry structure worked. Once you got into the majority of households and everything, somebody else could bring out a way better paper, but it wasn't going to go anyplace against you. I mean, you had such structural advantages that you could put your idiot nephew in, and he would do fine, wonderfully, and he nothing could happen to him except when this different medium came along. Now you can put in a genius, and whether that will make any difference is an open question. I would say that it's quite doubtful. If you own a newspaper, you want to do everything that you can think of, and fortunately everything anybody else can think of, because you can copy them so fast. And it may work in terms of product, and it may not work in terms of product, and it may work in terms of product and still not work in terms of economics very well. And I don't know the answer to that question. I know that we will play it out at the Buffalo News, for example, as strongly as we can. I don't think other people are going to get way better results than we are. I don't know what the other people what their results are going to be and how it will work. It would be crazy to sit on the sidelines and simply ignore what's going on. So we will do our darndest to have good economics when this is all through, but nobody knows how it's going to play out, in my view. The question about insurance, about whether we become average is not going to be good in insurance. Average is going to be terrible in insurance over time. It's not it's a commodity business in many respects. And if you are average, you're going to have a very poor business. You may limp along because you got a lot of capital of supporting the lousy business, but it's not it won't be per se. But I think in Geico and in General Re and our other operations as well, we do not have average businesses, and there's nothing about the way the industry is going that would force us or lead us to have average operations. I mean, we have special things we bring to the party in both cases I've named, and actually in other cases as well. We have things we bring to the party that should make us considerably better than average. It'll show more in some periods than others, and it'll be different in the way it is applied at Geico or at General Re or at National Indemnity's reinsurance operation. But none of those, in my view, will be average. But average, and there will be a lot of average by definition, average is not going to be good. The other problem about it is average is not going to go away either, so that is an anchoring effect to some extent on what even the skillful operator can achieve. I think insurance will be a very good business for us over time. Charlie?
Yeah, every once in a while we have a business sort of die under us. Trading stamps is now off 99 3/4% from its peak volume, and we were able to do nothing to prevent that except wring all the money out and multiply it by about 100.
We actually did about 120 million in the late 60s per year in trading stamps, far more dominant in our area than S&H was nationally. And we have, by skillful management, Charlie and my constant attention to detail, have taken that business from 120 million a year down to about 300,000 a year or something?
Oh, way less than that.
Yeah. We thought of having the sales chart here and turning it upside down to impress you, but it wouldn't have worked very well.
I think it's the nature of things that some businesses die. It's also in the nature of things that in some cases you shouldn't fight it. There is no logical answer in some cases except to wring the money out and go elsewhere.
Yeah, and that's very tough for managements to. In fact, they almost never face up to that. It's very, very rare. And it's logical to be rare. In a private business, you can understand why people face up to it. In a public company, if you take the equation of the manager, he or she may be far better off ignoring that reality than accepting it.